Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of March 24th. Thank you for joining us this week. Don't forget to like the video and subscribe to the channel, especially if you find these videos helpful. Also, if you have a few minutes, check out some of the other great video content that we post. So with that said, my goal for these videos is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that in mind, let's get ready to hit the books and get up to speed on the markets. So as usual, we'll start by looking back at last week. So surprisingly, last week, we didn't see a whole lot of new tariff information, although the big deadline that everyone's watching for is April 2nd. That's when a broad variety of new and delayed tariffs are supposed to take effect again. What we did see last week was some inflation data. The import and export prices in the last month rose by a significant margin. Some analysts and economists are suggesting that it may be that the new tariffs that have been introduced are already pushing up import prices, and that the potential for new tariffs and retaliatory tariffs is actually causing prices to rise even before the tariffs have been put in place. This is definitely one area that we'll have to continue watching. The big headline from last week was the Federal Reserve making their March interest rate decision. So, to get right to the point, the Federal Reserve chose not to raise or lower interest rates, but to leave them in the same place. Ultimately, the main message of the Federal Reserve's press conference following that decision was that there is so much uncertainty and there are so many unknowns in the economy and in the global trade situation that the best approach today is a wait-and-see approach. In line with the wait-and-see approach, the Federal Reserve didn't change their estimate of interest rate cuts for 2025, and they're still currently projecting 2 rate cuts by the end of the year. What they did change was their projections for the macroeconomic variables. The Federal Open Market Committee is now projecting that gross domestic product will grow slower, unemployment will rise higher than originally thought, and inflation will also rise higher than originally thought. All of these projection modifications were significant, but an important piece to keep in mind is that as the projections changed, the certainty or the confidence in these projections headed towards zero based on all the uncertainty right now. Although the change to the Fed's projections matches some of the stagflation concerns that we've been talking about the last few weeks, the Federal Reserve was very clear in their press conference to mention the fact that right now the economy is currently strong. The data may be softening, but what we call the hard data, meaning the true macroeconomic variables, are not in a bad place. Where we are seeing a lot of concern is in what we call the soft data, which is the survey data. So consumer sentiment, small business sentiment, manufacturing sentiment, projections for the future, all seems to have become very pessimistic. But the Federal Reserve worked very hard to remind everyone in the audience, as well as across the country, that the hard data is really what drives decision making. Although sentiment and soft data may be concerning, it's the point where that soft data turns into hard actions and changes in how consumers and businesses behave that it actually becomes problematic. And as for right now, the Federal Reserve happens to have quite a lot of ammunition in their interest rates that they can still change or tweak to fight either inflation or unemployment or the potential stagflation of both. The 2 economic variables that we saw come through last week retail sales and business inventories were both a little disappointing. Unfortunately, retail sales came in a little lower than expected, and business inventories came in a little higher than expected. Both are not good indicators for the future of the economy, but the caution, or at least the reminder, is that tariffs are causing a lot of mud in the water. It's hard to separate the effect of tariffs or tariff threats from the actual economic changes. So at this point, a lot of economists are looking at these reports with a similar wait-and-see mentality. Switching our focus over to the housing market, the National Association of Home Builders released their monthly housing market index, and unfortunately, the index has fallen. What we're seeing is a housing market that's a bit supply-heavy, meaning the number of houses coming on the market available for purchase has increased, but we haven't seen the demand to check that additional supply. What we have seen is that housing permits and housing completions both fell in the last month, but housing starts increased. This may be in part due to some lagged effects coming out of a very cold January and February, but it's certainly something to continue watching. We also saw last week the average mortgage rate on a 30-year fixed mortgage increased for the first time in several weeks. In a lot of ways, this is tied to the yield on the 10-year Treasury note, but this is certainly a factor in the affordability of housing and the sale transactions of housing moving forwards. So we're going to switch things up a little this week. Since we're talking about housing, we're going to jump into the 10-year Treasury, and then we'll circle back to the stock market. So the yield on the 10-year Treasury note is very closely tied to the mortgage rate on 30-year fixed mortgages. When the 10-year yield rises, we tend to see mortgage rates rise, and vice versa in the other direction. What we've seen recently was a pretty significant drop in the 10-year yield and a pretty significant drop in mortgage rates. But what we saw last week was a bit of a stagnation. So the yield on the 10-year Treasury fluctuated just a bit between 4.2 and 4.3%, ultimately ending the week at 4.25%. Taking a quick look at our alternative markets, we saw crypto and Bitcoin specifically continue to struggle throughout last week. The Bitcoin price hovered around 84,000, although we saw a couple momentary jumps up and a couple momentary drops. We ultimately ended the week just slightly higher than we started. Crude oil also did its absolute very best to have a down week, but the few upward movements that we saw throughout the week were enough to offset some of the declines, and ultimately crude oil posted a slight gain. The value of the US dollar increased throughout last week. There's a lot of concern and a lot of influence coming from the potential for tariffs, in addition to the actual tariffs that have been implemented. And the dollar and the markets for the dollar seem to be fluctuating in accordance with the tariffs. Last of all, we can take a look at gold, as gold is a preferred security or preferred safety investment in times of uncertainty. Last week was no different. We saw a pretty significant spike early on in the week in the price of gold, up as high as $3,050, but we saw a slight moderation later in the week. Finally, switching our attention to the stock market. We saw a relatively unique event occur last week on Friday. Stock options traders refer to it as the triple witching hour. Ultimately, it's the period where we see expirations of stock options, stock index options, and stock index futures all expiring on the same day, on the same hour. And ultimately, the result is typically quite a bit of volatility and price movement. Now, last week, during the triple witching hour, we actually did not see this phenomenon. The phenomenon and the expirations occurred, but we did not see dramatic volatility, possibly in part related to the uncertainty that already exists in the markets and traders' willingness to end the week and head into next week with a fresh start. Now, what we did see in the three major stock indices is relatively mixed results. We saw a slight down week for the S&P 500. We saw the Dow Jones Industrial Average ultimately break even on the week. And we saw the NASDAQ actually reflect a relatively large decline. So although there were some ups and downs throughout the week, all three major stock indices performed slightly better than they have in recent times, but didn't move into the positive in a consistent way. As we move our attention into this week, of course, we'll continue to watch the stock market. We'll be looking for the ongoing volatility, as well as any indication of which direction the investor sentiment is moving. But what we will see this week in two very significant ways is consumer sentiment. Early in the week, we'll see a consumer confidence report from the Conference Board. And later in the week, we'll see the finalization of the University of Michigan Consumer Sentiment Report. Both these reports are surveys capturing the feeling or the vibe that consumers have today, as well as their concerns and looks toward the future. This will drive a lot of the economic conversation during the week, but as the Fed mentioned, the hard data is what drives actual change. So what we're expecting to see as far as economic hard data this week is information on both gross domestic product and inflation. The gross domestic product report will be the final revision to the fourth quarter of 2024. This is ultimately economists and analysts closing the door on 2024 economic growth and shifting focus almost entirely into the first quarter of 2025. We'll also see inflation data, the Personal Consumption Expenditures Price Index, which, as always, is still the Federal Reserve's preferred measure of inflation, will come out towards the end of the week. Analysts are concerned, at least in small part, because the information we saw in the Consumer Price Index included carryover data that flows through to the PCE inflation report, and the data that flows through suggested that the PCE may in fact rise again. Now, it's important we keep in mind that we're watching trends and moving averages and not one-time reports. But any indication that inflation may actually be picking up or maybe gaining speed is certainly concerning and worth watching. Along those same lines, our look forward to the future, of course, we'll be paying attention to the tariffs on April 2nd. The potential for new tariffs and retaliation from our trade partners will have a significant economic impact. But I want to take just a minute to share the fact that during the Federal Reserve press conference following their interest rate decision, Fed Chairperson Jerome Powell did an excellent job being the adult in the room. He brought in a sense of cautionary concern with data-driven reassurance. Ultimately, he argued that the economy is not in a bad place today. We see some signs of softness. There's definitely a lot of fear and uncertainty in the soft data and the survey data. But there has to be a transition from fear and uncertainty to actual changes in behavior before that fear can actually negatively affect the economy. Now, it's possible we may already be seeing some of that, but it's important that the individuals who are responsible for reassuring the public offer a calming, reassuring, common sense approach and don't continue to stoke the flames of fear and uncertainty with off-the-cuff comments that could drive confusion and concern about the future. So along those lines, as I wrap up this week's market update, I want to mention the fact that when we put together these updates, we try to be very careful to bring forward the information you need, but to not create a sense of panic or to exacerbate your uncertainty. The economy is in a very unstable position, and we don't know where it'll be in the future, but that doesn't mean it will be bad. So I would encourage you, every week, come back and check out the market update, check out the ideas and the data that we're putting together, and try to find ways in your own life to find some reassurance and to calm your own nerves about a very unpredictable future. With that in mind, we'll continue to do our job. We'll sift through the data, reading the reports and watching the markets, and we'll bring you the most helpful information to keep you up to speed on the markets themselves. So with that, have a great week, and hopefully we'll see you next week.